Okay.
Okay, we're going to start. This is the New York Fire Department Pension Fund Investment Meeting. Today is 4/18/12. It is 10 o'clock. We're at the New York City Comptroller's Office, 1 Center Street, room 1117D, New York, New York. Could we have the roll call, trustees?
Roll call of trustees. Ms. Ranji Nagaswamy? Yeah.
Here. Apparently, I changed my name to Ranji this morning, and I'm better off for it. Thank you.
Mr. Larry Schloss?
Present.
Commissioner Franco, David Franco? No, student.
Now I'm still that person. I'm that person also.
Mr. Stephen Cassidy?
Mr. Straub has Mr. Cassidy's proxy.
Mr. James Levin? You want to
He's not here yet, but he's on his way.
Much better off than that.
Mr. Robert Straub?
Present.
Mr. John Kelly?
Mr. O'Connor has Mr. Kelly's proxy.
Mr. James McGowan?
Present.
Mr. John Dunn?
Present.
Mr. James Lamonda?
I have James proxy.
Mr. Sean O'Connor?
Here.
Commissioner White?
Present.
We have 22 votes and a quorum. We can start the meeting.
In as much as we all know that I think Lieutenant Richard Nappy died on Monday, we think it would be certainly appropriate to have a moment of silence before we start the public session of the meeting. So at this point, we will have a moment of silence. I just thought that I don't know if anyone knew the lieutenant, but if anyone did know the lieutenant, if you could share any thoughts, that would be appropriate. That would be good.
Richie was an excellent fire officer. Did a lot of volunteer work on the outside. He's wanted to be a firefighter since he was a teenager, and in fact worked as a volunteer in his teens. He taught firefighting to new recruits. He was a survivor of 9/11. He came in on his off tour that day and worked in the first 2 engine companies, 7 engine. And the guys that worked with him loved him, respected him, followed his leadership, and had nothing but great things to say about him. He's a young man, 47, leaves behind 2 children, a son 11 and a daughter 12, and a wife, Mary Ann. It's a very sad day for the fire department. But thank you very much for acknowledging him. We appreciate it very much.
Thank you, and thanks for the service of the lieutenant. Thank you very much.
Yeah, I'd like to make a brief statement, too.
Go right ahead.
Yeah, it was a sad day for the fire department. The lieutenant is a former delegate of the UFA in 2 companies. And he was always a great delegate, always participated, represented his members well, and I think we're all going to miss him.
Thank you. Any other comments? Okay. With that, we'll start the public session of the meeting, and we'll start with the monthly performance reviews. Larry?
Okay, does everybody have a color copy? Yeah. Good? Okay. So we'll go pretty quickly. It's a nice month. We should probably go slower because it's nice, but let's just start on page 3 quickly with the economy. Again, we're the blue line, so it's slowly upward. Slowly is the order of the day. So if you jump to page 6, you can see, again, it's slow, but it's clearly a trend, and it's less weekly unemployment claims, which is really what you need to get the engine going. You can see the next page 7, the unemployment rate is dropping, but part of that is the denominator. People are stopping to look for work. So it's actually not even as good as it looks. thumping through. Go to page 10. Look at architectural billings. I'm a little concerned that it's flat for the last couple of 3 months, because you'll recall it's a leading indicator of industrial construction and commercial construction. If it goes flat, it means people are very, very cautious again. That doesn't bode well again for continued job creation. You can see the next page 11, housing prices are still going down. That's not good. Home sales on the next page up a little. You are seeing, however, on page 13, a little bit of new housing construction. At some point, the inventory needs to get rebuilt. But again, very slow, taking its time. I'll get you again quickly to jump to page 22. So I guess the overall comment on the U.S. economy is slow improvement, high unemployment, the Fed doing everything it can do, all eyes on Europe, which has fits and starts. Recall that in December, the ECB flooded the market with 3-year loans. That made people feel better. That's reflected in this chart of the VIX, which is volatility in the U.S. equity markets. Again, it got very, very calm again in late December, January, February. It's now starting to bounce around again. Primarily because people have now figured out that now that the relative impact of that ECB move I just referenced is interesting, helps the banks out. The banks can buy some country debt in Europe, but still you haven't solved the fundamental problems of over-leverage, underemployment, and austerity, which is around the bend. The next page on 23 is the yield curve. This is yellow. The yellow line is the current yield curve. The white line is the current yield curve. Again, the Fed has been pretty vocal, even though people don't want to hear them all the time, is they're keeping rates down. They said through 2014, they mean it. People think they don't mean it. They mean it. That's good for people trying to take risk. Because they want people to take risk. You can see on the next page, 24, 10-year Treasury basically has bounced around 2%. There was a brief point where it spiked to 220, but it's back down to about 199% again. The risk-on trade, if you will, which has been going on since mid-December, is on 25. It shows you high-yield bond spreads. The 584 is down from something approaching 800 again when in let's call it October, November. Again, people are listening to the Fed, but with one ear and watching Europe with the other ear. That said, if you look at page 27, all the firings did manifest themselves as increase in corporate profits. So profits are going up, and at some point that's a good thing. They'll be rehiring whenever companies get more comfortable with the forecast in the future. It's also good for the underlying earnings of the stock market, so stocks get cheap. At some point, stocks rally, which is what you've had in the first quarter. On page 28, you can see the major indices, the Russell 3000, EFA, and the emerging markets, all of which are not very expensive on a historical basis. The U.S. probably is closest to sort of what I call fair value, but still on the cheaper end of things. If you go to page 30, you can see the dramatic impact that was had, again, with ECB's move in the middle of December. You can see all the markets have gone up. But again, in the last, I'd say in the month of April, a lot of volatility's come back in the markets. Spain's having problems, or not problems. People are focused on Spain and Italy for financing. That's got people, again, thinking about what's going on in Europe. And maybe we should take some profits in the stock market. If you look what that's translating into on page 32 for fire, we're back up to about the highest level we've been in all year, $8.1 billion. And if you look at it on historical perspective on page 33, again, this is at the end, this is June 30s of every year, so we're up a little less than 2% since June. I think we probably gave a little bit of that up in early April. But again, the market's now bouncing around 100 points plus or minus a day, so hopefully this is just a respite and we'll keep the markets going back up. If you go to page 36,
Harry, that represents new highs, right?
yeah. Well, it's not quite. If you go to page,
We're close though, right?
yeah, if you go to page 32, I'm sorry, 32. These are monthly highs. So you're a little bit shy of the monthly high in the last 12 months, which was last April. That's the high.
What's the high, Larry?
The high is 8,161,000,000, and we're at 8,133,000,000. So spitting distance. And again, if you look at it on the next page on 33, again, as of June 30, if we stop the clock, it would be the highest, but it's not the year end yet. So time will tell. We got 3 months left to get us, to keep us at the high and get us back to 8%. It all just depends on the markets, obviously. If you go to 38, you can see where we sit relative to the adjusted policy weights. Recall that the adjustments are temporary places where we put our capital because some of the things we're doing just take time. So again, you got the ranges here. You can see pretty much we're leaning into equities and we're
You said
leaning...
38, but you mean 36.
I'm sorry, I mean 36. Sorry. Thank you, Mark. 36. So again, if you look at, thanks, Mark. If you look at the bars where we stand, we're probably a little over in equities, a little less into fixed income. It's hard to make money in fixed income where we are, and as you know, we're rotating into emerging markets, into hedge funds, into opportunistic fixed income, and we have these temporary places which are all adjusted in these bars. If you actually want to see the math of it all, it's on page 37. So the relevant numbers on 37 are the actual numbers relative to the adjusted policies, relative to the adjusted ranges, and we rebalance things to the extent we get out of whack, totally out of whack, on a monthly basis or weekly if the markets are such that we need to do that.
Hey, Larry, just to hold for a second, I just
Yep.
want to note that Mr. James Slevin is present now in the meeting. Go ahead, Larry.
Sure. So, to put it in perspective, at the very top of page 37, the policy would tell you we're supposed to be about 65-35. With the adjustments, it's about 63-37, and it's kind of plus or minus 6. So if you add that up, we're a little bit over in equities and a little bit under in fixed income, all things considered. But again, we're moving some things around. As you recall, we just finished an RFP for emerging market equities, which was, SEMA, when's that being funded?
Sorry, Rich.
Emerging market equities?
Well, we've been funding it over the last few months, and
Okay.
we're going to finish it by June or July.
Right. So you'll see us moving more into that, and the source of that will be the cash, which is it's less than 2% now, as well as terminating some managers and hiring these new managers that we've got.
Larry, can I ask a question? Or just to say thank you for rearranging this page because it's now on 3 pages and it's a little easier for me to see. So thank you for doing that.
You're welcome. You can thank Mark.
Thank you, Martin.
We were going to do it color-coded, but it made it a little more complex.
Yeah, that's what I was going to ask you. So it's easy for me to see on page 36 where we're a bit out of whack, but it's really, with all these little numbers on page 37, a little difficult to actually see where we're out of balance. So could you do like wherever we're out of balance in red on page 37, for example, just to make it easier to see, and everything else in green or something like that?
We'll figure out some colors.
Yeah. Thanks.
Sure. That sort of gets you to page 40, which is the market moves in February. If you look at the far left column, you can see that, again, the first chunk is the U.S. equity markets, which are up about 4 to 5%. International markets were up sort of, let's call it 5 to 6%. If you go down, the bond, high yield, the investment grade market was didn't move much, and the high yield market was up about 2%. So basically everything was up. So if you then go to, skip the next page. If you go to page 42, you can see, again, the far left, the 1 month number was we're up about 3%, which brought the year-to-date number up to about plus 2%. Pretty much everything was contributing to last month as well as for the fiscal year to date. You recall it was very, very bumpy in October, November, December, so a lot of bumps. Now we're moving up, and we'll just have to see how the rest of the year fills out. If you go back one page now to 41, this is a glimpse into next month, which is the March results. So again, if you look at the top, the U.S. markets were up about 3%. That was offset by about 3% loss internationally. The investment grade and treasury market backed up the high yield. My guess is this will net to about zero. So to your question before, John, I would say we're probably about the same place end of March as we are end of February. So we're maybe up about 1.5% to 2%. So maybe, to your point, Doug, we might be at about the highest ever again. But again, this is March, and April's been very volatile, so I can't quite tell you where we are today. But probably about the same, plus or minus 1%. The next pages are all the manager stuff, manager by manager. Everyone's pretty much on track because the markets have calmed down, so people are actually starting to add value. There's one or two that aren't, and a couple of ones that aren't are in the process of being changed or reviewed. So that ends February's report. It was a good month. Expect March to be about the same level, and stay tuned to the rest of the year. Seema, do you have anything for equities?
No.
Mark?
We'll be talking about fixed income in the executive session.
Barry?
Nope.
Ron? No? Okay. Any questions, or otherwise that ends the report?
Is that it for your comments in the public session?
That's it.
Before we move out of the public session, I just Mr. Slevin came in late, but I just wanted to indicate to him that we had a moment of silence for Lieutenant Nappy and Robert Schraub and John Dunn made comments, and I just didn't know if you knew him and if you wanted to make a statement with respect to the lieutenant who died in line of duty.
I'm sure all the proper words were said, but I'll just say he was an excellent firefighter, former delegate for the UFA, if Bob hasn't already said that, prior to getting promoted. He will be missed, and thank you for everybody's kind words.
Thank you. Okay, we need a motion to move out of the public session into the executive session.
Make a motion to move out of public session.
Second.
Any objections? Hearing none, we're moving into executive session. I can manage and review